Dear viewers, welcome to this episode of Expert Speaks. We have completed one quarter in this calendar year, January to March 24. A lot of things happened in the stock markets, both in India as well as in rest of the world. The expert of the week, fund manager Harini Dedhia, is going to brief to you what she observed, what are the threats and what are the opportunities she is observing in the markets across globe. This is NRI Money Clinic for you, and I am Dr. Chandrakant, but your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
Harini Dedhia is not someone who is new to you. She comes on our channel every now and then and she does this quarterly episode called Threats and Opportunities of India Stock Markets. She is going to take you through today the scorecard of Indian markets as she saw in the last quarter. Harini Dedhia is a young upcoming fund manager, very popular these days. The funds managed by her have got excellent ratings both on the CRISIL as well as the PMS Bazaar. She started her career way back in New York through a hedge fund. Later on, she came back to India and currently she is the head of equity and fund manager at Tamohara Investment Manager, a boutique PMS firm. It's over to you, Harini, to take you through what happened in the markets.
Thank you for the very kind introduction, Dr. Bhatta, as always. It is a great pleasure for me to be here again on your channel to discuss the quarterly market update, where we will discuss our broad macro views and our view especially on the Indian equity market, followed by a quick look at what we expect from the different sectors to do going forward. So the last time we interacted, it was in the month of Jan. So it's almost been 3 months since. And it's been a very exciting 3 months. After a one-way move that we've seen, we saw some amount of volatility come into the equity markets in the month of March. So we believe that things are going to start getting very interesting from here on. So as always, we'll just go through quickly what has happened in the last quarter. We've seen the rally in the market continue. But what is very interesting is that this time around, from Jan to March quarter that's gone by, we've seen gold outperform equity, at least in Indian markets, by a significant amount. And that is something that tells you about the risk appetite, perhaps, of people, right? Where you see a lot more demand going in for gold versus equity on a relative basis, of course. What we are also seeing is we had discussed two specific points on the macro scenario last time. We discussed interest rate cooling off. We've seen a slight pickup in that, as seen in the US 10-year, because we have seen some amount of commodity rally. We've seen that in the crude oil prices. That was also another factor we discussed last time around, that we would expect more volatility in crude oil, given one of the smaller nations had exited OPEC at that point of time. And that has persisted, and we've seen that impact inflation and therefore reflect itself in the 10-year of the US Treasury as well. However, what is important to note is that this level is still significantly below what we saw last year in the month of September, October, where we saw the 10-year touching almost 5 percentage points. So all in all, on the macro front, we are seeing more volatility, more sideways moves, barring gold and crude oil. So crude oil indicating, perhaps some supply side tensions. On gold, perhaps flight to safety for some, flight to some alternate fiat currency for some. But all in all, macros have been flattish, and that is also indicated by our own scoring system that we have in place, where we've seen more or less companies maintain their scores through their sector. So the average score for BSE 200 companies has been held constant at 59 this time around as well. So really now diving into the Indian equity markets and how the underlying has performed. We've seen a 33% plus growth in BSE 500 in terms of stock price. We've seen a tapering down of sales growth, EBITDA growth and PAT growth versus what we had seen in Q2. So we are definitely seeing that normalization has taken place, and now it's really up in the hands of sales growth to come and deliver. Whatever had to be done in terms of earnings magic, so to speak, has been delivered by margins, right? We've not seen any sales growth or any meaningful sales growth any which way that has come through this year. 3% sales growth is not really befitting of a growing economy. And this is the one thing I really wanted to highlight, right? Because our margins are now nearing all-time peak. It's very difficult for us to see margin expansion from here onwards. And in fact, in the last 1 month, we've seen some of the base metals like copper, aluminum, really see a up move in prices, and that will come and haunt some of our manufacturing margins as well. So we're not really expecting margins to move up from here in a significant manner. So for us to see any meaningful growth, sales growth has to be the driver. It can no longer be margin expansion. And that is where I wanted to highlight a concern. But before we get into that, I wanted to also highlight another point where, because the market has run up the way it has, we've seen a 33% move backed by just a 3% sales growth, a little bit a 30% plus earnings growth. The earnings growth has now been more or less priced in. So if we really do see, for most mid-cap and small-cap companies, there is a majority of companies that have actually missed their consensus estimates. So when we look at the earnings growth number, the political stability that we're seeing in India in terms of continuation of current regime, entire narrative that is getting built by a lot of global companies about India being the next market that they're going to look at, all of that being said and done, we are seeing volatility, and I think it will persist going forward as well. The reason for that is very simple, that on the small and mid-cap front especially, we have run ahead of expectations, and that is clearly being seen in the majority of companies missing their estimates, so to speak. And this is something to bear in mind. So sales growth really has to kick up for estimates to not get disappointed going forward. And here is where I wanted to highlight one concern that we have. And that concern is that while we are seeing some green shoots in private capex, we're not seeing an out-and-out private capex pickup that is required for the sales growth to come through. We're, as a country on manufacturing, we're operating at about 75% utilization. If private capex does not pick up and sustain for a couple of years, it would be very difficult to imagine growth beyond a certain threshold. Because remember this, that it's not possible to run machines at 100% utilization. There is always going to be downtime, repair time, public holidays, all of those things that come into force. So typically capacities peak out at 85%, perhaps 90% in some industries. But for most part, they peak out at 85%. So there is only a 12 to 15% gap that's now open for manufacturers to grow into without really doing meaningful capex. And we need private capex numbers to step up to really see that growth sustain. And that is currently not the case across the board. And I think the best way to highlight this is probably through the FDI numbers. One story that has been talked about and touted about a lot for the Indian manufacturing is China plus one, right? We've heard this multiple times since the onset of COVID. But when you see the data, when you see the FDI flows, in fact, 9-month FY24 has been the worst ever year. And this is after a very bad 2023 as well. But 9-month FY24 has been the worst ever year in a long time in terms of FDI inflow. Now, this could pretty much also be a factor of higher investments that came in 20 and 21 and 22 as well. But perhaps also a factor of where the valuations are and companies that are putting meaningful capital on the ground, not really seeing a return on their investment match up to what their threshold IRRs are, right? Because for us in the stock market game or the investing game, where we're buying as minority shareholders on enlisted securities, it's very easy for us to get out and make our IRR. But if I'm putting up a new factory, I really need to see that factory pay back the investments that I'm making. And we're not really seeing that, perhaps happen for a lot of the larger companies, a lot of the foreign companies, which is why we are seeing FDI net inflow just at $8.5 billion for the 9 months FY24. So this is something that's a cause of concern for us. And when we think about it, if we are not getting the benefit of China plus one, who is? Where is this money going? The answer is very surprising. It's actually going into the US. In fact, US has seen the highest gain in share of FDI. These are foreign flows, right? This is global foreign flows. US has seen a massive step up. This could be because of a lot of supply chain restrictions that have been put up. The CHIPS Act that has been enacted in the US. We've seen countries like Mexico, Brazil, Poland also gain. but it is surprising that US has been one of the larger beneficiaries of this China plus one move. And surprisingly, India has not really seen a significant needle shift move that has happened. So this is something that if I were to be dramatic, this is something that would keep us awake at night. That we want to see this change, because without private capex sustaining, it is very difficult for us to imagine sales growth sustaining, and therefore without that it would be very difficult to imagine earnings growth sustaining. So this is a data point that I think all of us should bear in mind, keep in mind for markets at large. But having said that, there's always opportunity. Diving straight into the sectoral review for now, I think it is imperative to take a look at how markets have behaved over a longer period of time, right? While we've had a timid 2022, but the bull run can be said to have lasted for about 3 years now, since the fall or correction of March 2020. Just to make sure that we're not taking an aberrational start point, let's look at how the markets and sectors have moved since Jan 2020 to March 24. And what we see that significant amount of gains for a lot of the sectors have come from multiple expansion, right? What we have therefore tried to parse out is what sectors are growing at what CAGR over the last 5 years, and what are they expected to do over the next 3 years or so, right? And the sectors in the highlighted box slated to see in estimates, and we can be horribly wrong in our estimate, but are slated to see a PAT growth that is higher than the PAT growth that they've seen in the last 5 years, right? Within that, I think the one sector that we would like to call out is Nifty FMCG, simply because it is the only sector in that highlighted box that has not seen majority of its gains come from multiple expansion. So there has been a decent earnings compounding, which has led to that 75% increase in the index that we've seen, along with a 17.5% multiple expansion. But for most other sectors, be it IT, be it auto, over 50% of their gains have come from multiple expansion itself. So for cap goods, half of their gains have come from multiple expansion. We've seen 1/3 gains coming from multiple expansion for auto and manufacturing. Within the metals, close to 40% has come from multiple expansion, but that has come from a low base. So I would, excuse that one partially, because a lot of those balance sheets have really turned around and have gone from significant leverage and debt to a significant cash flow generating machine now. But overall, I think FMCG is one spot where it's a great way to hedge your way into the volatility. It is a way for you to participate and still not get caught up in the volatility of earnings, in the private capex cycle, picking up or not picking up, and all of those questions. I would also like to highlight that be it metals, be it manufacturing, be it capital goods, while the run-up has been steep, the next 3 years PAT CAGR is expected to be far greater than what we've seen in the last 5 years. So we may not see multiple expansion. We perhaps most likely would see a multiple contraction here, but there is earnings growth to justify buying into the dips in these segments as well. And that is something that we would want to highlight. And the other one would be Bank Nifty. And if I were really to look at Bank Nifty and, parse out the PSU banks, which were not having earnings, in fact, 5 years back, and now actually throwing out a lot of profits, the private banks have, not performed as well. The two of the larger private banks, HDFC and Kotak, have not done much. And so a lot of the re-rating that has happened in the banks has come into the PSU bank. So we've seen PSU bank almost a doubling of the multiple, whereas on the entire Bank Nifty as a whole, we've seen only a 20% multiple expansion. So I think private banks, we've actually seen a multiple contraction. So that is something that could also be a significant area of opportunity. So one should take advantage of any volatility that we see in the market and try and consolidate in stronger companies where you have much larger conviction in. In a bull market, we tend to gather a very long tail of companies, right? Because everybody seems to be doing well and you want to participate in all the narratives that are out there. So this is the time to really sit down and ask yourself that question. What am I most convinced about? Where is the growth completely internal and endemic to the company? And where is the growth reliant on a lot of other things aligning, a lot of other stars aligning? And take this time to really consolidate the portfolio into a much stronger one. I'm at this point no way saying that one should get out of equities or Indian equities. I'm a fund manager, so also because I truly believe that with a 12-13% compounding in earnings for the broader markets and double-digit compounding across most sectors, it's very difficult for one to see severe price corrections sustaining. You could see time corrections on the broader market, which is what we are possibly expecting. We could see sideways moves, we could see volatility, but we may not see sharp drawdown sustaining. So any chance that we get in this volatility to consolidate into stronger companies where we believe the quality of the earnings to be better, the growth visibility to be better, one should take that, which is where we wanted to really highlight private banks and FMCG, but also some capex companies as well. Should you get some amount of price correction in those as well? Remember this, it may seem very counterintuitive to really look at private banks, FMCG, because these sectors have not really done much, or even luxury consumption and things like that. But remember this, that at every temporary market peak, your winners start rotating, right? So in 2014, we had industrial and financial services leading the charge. Today, industrials, in 2021, industrials was in the middle of the pack. Financials was way below. We don't know if this is a market peak, which is why we've not put in the names for 2024. But we pretty much all have seen what has happened in the market and know how the sectors would stack up in 2024. Should this be a temporary market peak, even from a time correction perspective? What one really needs to be cognizant of is that sectors typically do rotate, right? Winners of the last move up in the market are not the winners of the next move up. So always try and take opportunity in any volatility to consolidate your portfolio stronger, where you have comfort on quality of earnings and on valuations both. At the very end, let's revise sort of what we had spoken about last time in terms of our personal views on sectors. In auto, we found valuations to be unattractive. And in fact, with what has happened in the last 1 month, both in terms of poor numbers being reported by passenger vehicle and two-wheeler in terms of volumes, and in terms of commodity prices going up significantly, we're likely to see some volumes being subdued. We're likely to see some margin pressure. So with valuations being unattractive, this is not really a segment that we're looking at for now. In banking, we believe valuations at large are reasonable, but we do prefer private banking to PSU banks at this point of time. And in real estate, we spoke of this cycle coming out of the woods after a long time. Currently, our view is that private banking is at its cheapest level since the last 8 years. And this is typically the level from which we've seen it bounce back, right? So that's what the chart essentially is saying, that if I were to look at Nifty private bank to Nifty ratio, it's pretty much at the level from which it generally rises again. So we would be positive on private banking. We are positive on private banking, and disclaimer, we're biased. So please do your own research. On the capex front, we are confident on government capex continuing. That has been a hallmark of the current coalition government that's in place. But we also want the private capex to sustain, for it to be meaningful and to see a wider participation by a wider set of companies into this trend. The last thing that we wanted to highlight is consumption. Now, of course, we've spoken a little bit about FMCG, and that might be a great tactical play, but luxury consumption is what we believe a decadal play in India. Just think about it. We are adding 11 crore rich people in India with an average per capita of $12,000 per year. We are adding 28 crore middle class with average capita income of about $4,500 per year. Together, we're essentially saying that there are 40 50 crore new customers or consumers that are going to enter the organized consumption for, right? Because this is the middle class and the upper middle class and the rich, the ones who consume brands, be it branded biscuits to be it branded cars, right? And we're essentially adding a Mexico and an Indonesia in terms of consumption. So this is something that we would continuously be adding in our portfolio and take advantage of the volatility, any volatility that the market may present to add to these positions. But that is something that is a far longer term view. In the short term, we may see some respite come in because of better rains or just rural economy picking up a little bit from the lows that we've seen last year. And therefore, FMCG may be a more tactical play there. It's also a great way to ride through volatile times. And we just don't want to write off capital goods and manufacturing as a theme yet for two reasons. One, we're very aware that it's the hallmark of the current government to run a more investment forward strategy than a more consumption forward economic strategy. And so CapEx theme, so to speak, would be a natural beneficiary. But what we would like to see is private CapEx sustain. And that is our concern today, that would private CapEx sustain or not? Because that would really determine the kind of capital good companies that we would go after, right? So if you're seeing a lot more government projects do well, let's say we would go after companies that cater more to that. But there are a lot of businesses which have a far greater relevance in private manufacturing. Like it could be welding, for example, or some sort of fabrication, which is far more relevant in automobile industry or industrials industry. And those are far more relevant to private CapEx sustaining. So that's the caveat on the CapEx front. But I think what our overall message would be currently is that this is the time to take a chat with your financial advisors, see where your conviction is the highest, and definitely add to or consolidate more into your higher conviction bets, your understanding wherever you believe the quality of earnings is, or the quality of the manager or whatever it is far stronger. So take advantage of the volatility to do that. And that would be our internal agenda as well currently. So thank you so much for having me on the show as always, Dr. Bhatt, and look forward to chatting with you next quarter.
Dear viewers, hope the episode done by Harini Dedhia gave you insights about what fund managers are seeing and the threat and opportunities of Indian stock market. If it did give you a direction of the markets, please do not forget to give me a thumbs up. Again, requesting you, please do subscribe to this channel, press the bell icon. You will not miss one single episode whenever we release it. Needless to say, we produce 2 videos every week. Every Tuesday, an expert comes on the channel, and every Friday, I speak my mind out on your life, your money. Don't miss one single video. Thank you very much for watching this episode on NRI Money Clinic. I shall be back with you with yet another episode of Expert Speaks next Tuesday.
Press the bell icon for more details and subscribe our channel.